Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by partner and head of policy research, Dan Clifton, to talk all things election. But first, Dan, how are you doing today?
I'm doing well. It's great to be with you, Ross. Thanks for having me on.
Tremendous to talk to you, obviously very timely. So I want to just turn it over to you and get your very highest level view of 2024 and the macro outlook for the year here.
Yeah, listen, this will be the largest election year in world history. I know that sounds exaggerated, but more people will vote in 2024 across the globe than any other year that we have in recorded history. These elections are going to happen at a time of growing geopolitical strain. They're going to happen at a time of rising populism and just a population of voters that are restless over somewhat sticky inflation for the price level, not the growth rate. And that's probably going to lead to significant change. These elections are happening, obviously, here in the United States and the UK, but you're going to have parliamentary elections in the EU. So nearly all of the Western world is voting this year. And on top of that, you have elections happening in what I call the onshoring countries, India, Taiwan, Mexico, all critical places that are starting to take on increasingly more of the supply chain as you have an outmigration from China. And so I don't think it's just going to impact this year. The political change that can come from that is going to have long-lasting effects in the years ahead. Now, what's very interesting is that this is going to be a very noisy year for political noise, so to speak. And yet, when you think about it, presidential reelection years like we're in here has been very good for the S&P 500. In fact, the S&P 500 has increased in every presidential election year since 1944. So that's 13 presidential reelection years in a row. And what's very interesting is that we've done an analysis looking at the return profile of the presidential reelection year, and then we compare it with an open election year where there's no incumbents. And the S&P 500 performance differential is really, really large. It's about a 13% difference where stocks are higher in the presidential reelection year than when there's no incumbent. And that tells us that these presidents are using the levers that are available to them to try and prime the economy to get reelected when they're in their reelection years. So as noisy as it's going to get this year, and it will get very, very noisy, there's a bit of an underlying cushion that could be provided through increased fiscal stimulus, increased monetary policy stimulus, and of course, liquidity being provided by the Treasury.
That's a great context and I think really useful for our clients. But let's dig in on what you're talking about there. So there are levers that can be pulled to kind of prime the pump here in 2024 on both the fiscal and the monetary policy side. What are some of the ones you're watching and what do you expect the economic impact to be?
Yeah, so first, let me say that what we're seeing is that the president has put forth a series of proposals that will likely come into effect that we know about already. So what does that mean? We're likely going to get a big student loan cut on July 1st. Right now, you can only pay 10% of your income to student loans. That's going to move to 5% on July 1st. So if you think about it, the president's not doing really well with younger voters. They have high student loan debt. He's going to deliver a student loan cut. This is the most climate change conscious president that we've ever had in America. And yet every week, oil production hits a new high. He's pumping that oil to keep oil prices low. Because what we know is that after tax, after inflation income is the greatest predictor of the vote that a president gets in their reelection, and gasoline prices are a very big part of that. Additionally, something that we've talked about here is that you have a lot of infrastructure money coming online. That's the infrastructure bill that passed in 2021. That's the CHIPS Act for semiconductor facilities, and it's the Inflation Reduction Act money. So that's about $100 billion of infrastructure financing that's going to come in this year. And then to your point, there's a lot of tools on the monetary and fiscal side. Inflation growth rate is coming down. The Fed chairman this week seemed to downplay the very hot CPI report in his meeting with congressional Democrats. And so I think the Fed thinks that they've won on inflation. They're probably going to cut interest rates 3 or 4 times this year, probably starting sometime mid-year. Additionally, we believe that the Fed is going to end quantitative tightening and the roll-off of their balance sheet probably starting that sometime mid-year, and they could be done as early as September, if not by the end of the year. So those are two massive monetary policy tools that could also be employed. And then finally, we expect the Treasury Department to provide a host of liquidity in the second half of the year by the way they finance the deficit, by using T-bills rather than long bonds, and by spending down the Treasury General account into the election. Something very similar that was done in 2022 into the midterm elections. And so when you pull all that together, you're probably going to see a lot of liquidity. That liquidity is important. It keeps financial conditions loose. You're going to see a lot of fiscal stimulus. There is one caveat to that, and that is that you start to get a roll-off of some of these consumer aid programs. And so we're switching from consumer aid stimulus to more investment aid stimulus, which is showing up through the infrastructure side. Then you have Congress, and that's less decided at this point. There are really two important programs that I would keep an eye on. The first is that the House of Representatives, which seems to not be able to pass any piece of legislation these days, in a bipartisan manner, passed legislation 2 weeks ago that that would expand the child tax credit and provide retroactive tax benefits for corporations, allowing companies to write off their R&D expenses, research and development, allowing companies to write off their capital equipment purchases, and allowing companies to deduct more money from their interest costs. And this is retroactive. It's about a $135 billion tax cut for 2024. And then finally, what I think real inflection point for growth this year will be whether the IRS releases more employee retention tax credit payments. This is a COVID program that paid small business owners $26,000 per employee if they kept those employees on their payroll. That program is on hold right now while the IRS searches for fraudulent applications. But Ross, there's over 1 million applications sitting at the IRS right now, and a lot of that could likely get paid out after the April tax season this year. And if that comes out, I think it's going to have a big effect because it starts to offset some of that lost consumer aid that I talked about previously. So Congress is worried about their election. President's worried about his reelection. That means that there's probably going to be more is more here in terms of stimulus this year. And it's going to leave us with a lot more problems in 25 that we're going to have to think about, whether that's going to be the deficit or inflation or just a hangover from all this stimulus. But here and now, looks like Congress and the administration are going for it as we get deeper into the election year.
Well, Dan, it's a lot to watch, but that's why we are lucky to have you and your team at Baird. And so we want to thank you so much for your time today. I know we'll get a chance to talk to you again before the election in November, but really appreciate the time and the insight. Have a great one.
Great. Thank you.